Welcome to the Fund Selectors podcast with me, your host, Lucy Walker. I am a huge supporter of the voice of the fund buyer, and this podcast delves deep into the minds of the biggest and best in our industry. Today, I'm delighted to welcome Ryan Hughes, Investments Director at AJ Bell, one of the fastest growing platforms in the UK. Ryan built the investments business from scratch, and today those assets stand at £6 billion. His 25-year career shines through with the many nuggets that he will share in this episode. I think it's absolutely fascinating hearing how he built that investment business from scratch and how his early part of his career doing financial planning actually has really guided him to understand how his clients and how financial advisors really think. This episode covers everything from active and passive, right through to what asset managers need to be doing to survive and indeed thrive in the years to come. I really enjoyed the episode and I hope you do too. Hello, Mr. Hughes. Great to have you on the Fund Selectors podcast.
Hi there, thanks very much for having me along.
My absolute pleasure. Now, you and I have known each other for quite a while, and your career, I think, has been an interesting one to take a look back on. But I wonder if we could start at the point at which you became aware of this kind of world of fund selection, because for a lot of people I speak to, it's not always I was born and I knew I was going to be somebody that spent my career in this industry. So can we just take a step back and look at what led you to this point?
Yeah, absolutely. I perhaps am unusual in that I was one of those people when I was younger, that I thought I want to move into the world of investment. And that goes right back to school for thinking about investment and investing. Not that I had any money, but my family didn't have any money either. But it was a world that always interested me. And then when I was at university, I really specialized in investments, despite doing a business studies course. But I kind of specialised down over each year to get more and more into investments. And then actually, while I was still at uni, one of the lecturers knew of a job at a financial advisor firm and asked me if I should apply. They thought I'd be good at that. And so I did apply. And so I learned, I started out in financial advice and ultimately became a qualified advisor early on, quite soon after uni. But I realised quite quickly that pensions are really complicated. Trusts are even more complicated. And tax, well, you're never on top of it because the government keeps changing the rules. And the one thing I really enjoyed was investing. And so very early on, I thought, actually, this advice side of things is not for me. Fund research, meeting fund managers, learning about the economy, how to invest, how to construct portfolios was where I thought it was at. And so very early on in my career, maybe only after about probably 2 years, I moved into specializing in fund research, portfolio construction and investment. So yeah, maybe I'm one of those unusual few that did have an eye to the path early on.
I love it. And what do you think was what enticed you? What led you on that journey when, as you say, that wasn't something that you'd been exposed to perhaps in your earlier years?
Yeah, I think it's the beauty of it was always to me that you never stop learning. Every day you learn something new, and the market is brilliant because the moment you think you've nailed it, it reminds you that you haven't. And I found that really fascinating early on. And also, yeah, I started out in 1999, so there were quite a lot of world events going on early on at that point. We had the last throes of the tech bubble, and then obviously sadly went into the tech crash, and then into 9/11, and then the Iraq War. So really early on in the first few years of my career, you had these big events, and I found it fascinating that what they did to markets, what they did to governments, what they needed to do for policy, how that impacted the overall economy, how that then impacted companies and their profits and investing. So I was always interested in the world, always interested in economics, always interested in politics. And it struck me as it was a really interesting career as a way of stitching it all together, but with the viewpoint that you've never got it nailed.
And I'm guessing that is still a true fact today.
Oh, absolutely. I mean, anyone that claims they know what is going on out there at the moment, well, I don't believe them as a starter. You just, look at all the things happening in the world around us now, and and that's been true all the way through. I mean, I'm doing this now 25 years, and you could point to so many events in that time that shape the way you think, shape the way you behave, shape the way you invest, and that's so talking to the young people we've got in our team in those early years of their careers now is talking to them about making sure you absorb all of this that's going on, and that they won't realize right now that those events that are happening today will shape their future careers on how they think and how they invest. So you never stop learning in this business, and I don't think I'm sure there are lots of other jobs actually that it's like that, but it just feels like this is a job that you can never say you've mastered, and that keeps it so fresh and interesting all of the time.
I love that. Yeah, I completely resonates. I took it a step further by going out of the industry to then learn another world of things. But yeah, it's an incredible industry to continue kind of developing and growing in. So you left your advice role, and you knew that investment was the bit that kind of was your passion. Talk us through then, where did you go? And then that journey to obviously your role today, leading the team at AJ Bell.
Yeah, I mean, so it's quite interesting because in the advisor firm, the second firm I worked in, we were running everything on an advisory business, and this is very much in the early 2000s, so over 20 years ago, and we thought that was really difficult to do, and that clients weren't responding not all clients were responding to our recommendation letters. And so actually we set up a discretionary business and we launched a model portfolio service. So this is over 20 years ago. So
Was that the first or one of the first?
it wasn't a first, but I think we'll definitely say that we were early adopters of that approach, and starting to look at things like platforms and working out what they were and how we could benefit from our business. So that took me into the fund research, portfolio construction, and portfolio management side of things. Again, really early on in my career, and so that was great from getting that advisory background, and that really helped me today in understanding the pressures that financial advice firms are under and how they deal with clients, and the fact that I've had to sit in front of real clients and say sorry for losing some of their money. When you're going through that, it's a very personal experience, and that led me then on to going really specializing down the fund research route, joining the investment team at Scandia Life as it was, leaving the business I was in thinking I knew it all, arriving the Monday after in the new business realizing I knew very little there, which is always a humbling experience when you change jobs. And I remember being asked in my interview, how will you feel going from being the best person in your team to the worst person in mine? Which I thought was a really brutal question, but they were absolutely right in doing that. And that was interesting because Scandia, we were institutional in our approach. We were manager of manager rather than fund of funds. Lots of US managers that people wouldn't have heard of we were using. So it really opened my eyes to a much wider manager set out there. And that took me on quite a long process running money there. And then a complete flip through to a really small multi-asset business where there was only about 5 of us in the business, and they're building our own structured products and investing in investment trusts, as I've done early in my career, but we didn't do at Scandia, and then leading me on to AJ Bell, which was really about setting up the investment business. We didn't have any people, any product, any process, and no performance. So all those criteria that you and I would have judged fund managers on over all the years, well, here's a blank sheet of paper to start out and say, how do we want to run money? How are we going to research? What's important to us? What isn't important to us? And driving that forward to today, where we've got a team running nearly 6 billion of assets, and with some pretty good performance that we're very, very proud of, and a very nice position as an investment business within AJ Bell. So I've seen various sides of our industry, from advice through to fund research, through to DFM, through to institutional fund management, through to working on a platform. So I do think it gives me quite a helpful 360 view of the different component parts that make up both our competitors, our clients, and the broader market.
I can't imagine, being able to start from a blank sheet of paper. It's that kind of that classic sort of test, isn't it, that you ask maybe a fund manager, or you like to ask yourself, which is, if you were to start from scratch. But to actually start from scratch must have been a really kind of freeing and I imagine really interesting experience. I'd love to hear more about that, and how you really how did you even begin to think about that process?
Yeah, it is. It was really interesting. When you haven't done it, you think it's going to be really liberating. And I can tell you, when you sit down with that blank sheet of paper in front of you, it's really terrifying.
Yeah, I can.
Um, because you've got all you've got to go on is your previous experience, and you try and start really digging deep about what you liked about various places you worked, what you've learned from your colleagues, how you make decisions. I mean, of course, you're even thinking about what's the governance structure and how we're going to do this. So it's more than the daily process. It's the bigger picture process as well. Who's making decisions, how we're making them, how we're documenting them. So it really is end to end that you need to do it. And it evolves. I mean, I think it's the reality of any investment process. Even today, when I look back from 8 years ago when I joined, the process it's got the core essence of how we set it up, but it's changed so much as well in that, as we've got bigger, we've introduced more people, we've got more assets. Our controls obviously get better and more rigorous. So it is liberating though, and it does genuinely make you think about what are the good bits. Where did I make good decisions? Where did I make bad decisions? How did I make them? What can I learn from them? And how, what's important to me, not what's important to, when you join in an organization, you kind of slot into the existing process, don't you? Everyone's running along and you just tuck into the slipstream and you go in that process. When you haven't got that to fall into, you've got to really think hard about what is important to you. And I think we were quite, I'm going to say lucky, because we gave it a lot of thought, but we started on the passive route, and this is back in 2016, and it's obviously well established in 2016, but nothing like it was today in terms of the sheer momentum of assets that have flowed into that. So I think we got off to a good start by positioning ourselves well, and then slowly but surely added capability as we went, rather than trying to do all things quickly. Of course, you're excited with a blank sheet of paper. You want to do everything there, but about just being sensible and cautious and adding on incrementally as we grew the business has been really helpful to us.
The number of questions I have in my head is slightly out of hand. So let's start with the kind of that core essence. So what were those sort of philosophical principles that you began, that process and that team with?
Yeah, I mean, and the first one was really a big learning point for me in terms of how I reflected on how I started out researching. I started in an advisory business where basically, I think like a lot of people over 20 years ago would have thought that that active management is the only answer. If you were a fund researcher and you didn't use an active manager, it's kind of felt like a dereliction of duty there. Well, how can I not find a manager that is good enough to outperform in all of these asset classes? So our starting point was start with passive. Most clients need and want low cost exposure to the markets, and then build that out to say we're only ever going to use an active manager when we think they've got a genuine chance of outperforming after fees over time. And that is an anchor that we use still today across our asset classes that we use as a real way of making sure we're making the best possible decisions for our portfolios and our managers. So that was kind of point number one on the sheet on that blank sheet of paper, is if we're going to move away from passive, then genuine skill is what we're looking for in active management. And if we can't find it, don't be ashamed to go back to passive, because broadly speaking, low cost exposure to markets over long periods of time is going to be just fine for the vast majority of people.
For your 6 billion, what percentage today is in passive?
Yeah, roughly about 2/3 passive, 1/3 active. I mean, that's a lot of that is driven because we sell the AJ Bell funds are available to both the D2C business and the advisor business, whereas the active solutions are only available to the advised side of the business. So we've got a natural growth on the passive side. But we, as a house, we're also when we deal in the advisory market is, we're not here to preach to advisors about what's the right approach. So we've got passive solutions, we've got solutions which are predominantly active, but have got a lot of passive in, and we've got a straightforward blended solution. The advisor knows their clients, they know their own investment philosophy, and then we allow them to choose what's the right approach for them there. And it might be they've got a low cost, price sensitive client on one side, or they've got someone that likes the opportunity to try and deliver some greater performance over time. We have the same asset allocation across both of those. It's the implementation route's different, and that enables the advisor to have to make the choice which is right for each of their individual clients, rather than forcing them down one particular route.
And did I hear you correctly that the D2C, the sort of, if I became a customer of AJ Bell, I would only be able to access your passive range?
Yeah, so the AJ Bell funds are passively implemented. They're certainly actively managed, but passively implemented. But our NPS solutions, yeah, they're advisor facing only.
Okay, interesting. So you decided not to go down the route of having, an option for your D2C market. I guess that's aligned with the view that you sort of said at the beginning, that for most people that works. But I suppose it's quite a differentiated decision to decide to actually not give. I suppose they can buy directly, but they can't buy a sort of a blended solution off the
They
shelf.
can't buy a blended managed portfolio solution on the D2C side of our business. Yeah, the AJ Bell funds are the route. And think about those typical customers. They're very often, they might be taking out their first ever pension or their first ever ISA or consolidating pensions. And again, these are long-term relationship, long-term clients. Someone taking out the first pension 25 years old, maybe you could easily be a client and invested with you for the next 40 years. And so giving them low cost market exposure, particularly for those that aren't interested in researching their own investments. And then we have to remember that so many on the D2C side, I just haven't got the time or the inclination to actively manage their portfolio. And we should be able to give them a nice range of products that gives them the low cost market exposure.
And are you seeing more growth in D2C or in advisory?
Yeah, I mean, we see growth across both bits of our business. Certainly in the D2C side of the business, it's there's that long-term structural tailwind really behind that, where the government, for all its critics, and I would be the first to criticize them for many different things, one of the things they've done very well is that encouragement for people to take control of their financial future. Obviously, we've had auto enrollment's been there now, but also just the general importance of people looking after themselves in that long run, if you want a good retirement and so on. So we've seen really exciting growth in the DC area, but also the advisory business. It's seen so many people using advisors to consolidate their pensions, or they've accumulated some wealth and they've got to that stage where they think, I'm a little bit nervous now about, perhaps I'm more worried about losing it than making even more, and I need the help of an advisor from a tax side of things or so on. So we see good growth across both parts of our business, and I think both have got good tailwinds in terms of that long-term structural trend about people needing to do more to look after their future.
Yeah, God, that's a whole nother podcast, I think, isn't it? Digging into that. I've seen some absolutely crazy stats recently on that. All right, so let's dig in. So you've got obviously 2/3 in passive, and I don't think we need to spend a ton of time on that, given that my assumption is that you're looking for low cost and low tracking error or tracking difference, etc. Correct me if I'm wrong. So perhaps on the active side, where you've articulated that really important point about needing to see a repeatable edge that's going to allow that kind of long-term outperformance. So perhaps we could spend some time just digging into what you feel that really means.
Yeah, I mean, you're just on the passive point. You're broadly right. My passive research team would be giving me a very hard time if I said that was all they were doing.
I
there.
actually have met your passive one of your passive team, and I know that he would really have a go at me for having done that.
He massively oversimplified my whole job at that point. But yeah, broadly you are right. But we do. Yeah, it is an interesting area of the market because of new entrants and disruption that's going on, and price pressure, and also the fact that critical mass makes a difference as well. So we do look at a lot of other factors. As well as those things. Trading costs would be one that's so important to us as well, particularly when you're buying ETFs, and how you execute becomes very important to us. But on the active side of things, for me, nothing really unique in terms of how we start thinking about this, in terms of wanting a well-articulated investment philosophy, in terms of does the manager understand and can they articulate how their bit of the market is inefficient, and how they want to go about exploiting that inefficiency. So that whole process side of things, is it repeatable? Is there a consistency around that philosophy and process are the two big things for me. I'm not a natural mathematician at all, and therefore that whole debate about is this an art or is this a science? And I think very often people that are very mathematically minded will tell you this is much more science, and those that aren't will say, well, actually you need to blend a little bit about the art and the science. And I'm very much of the latter there, in that the judgment that we're having to make, the analysis and the assessment of not just the how managers go about doing their job, but how do they bring their personality into that? How does that affect their decision making that they have? What's the framework around decisions in terms of the check and balance in the system, so people can't go rogue and get carried away? So we really focus very much on that deep understanding of the philosophy and the well evidenced investment process that we can see has worked over a period of time. So I'm very much a fan of experience in the managers that we deal with. Lots and lots of interesting up and coming fund managers who've been around a few years and have got some very impressive numbers. But have they genuinely been tested? Has their process gone through a full market cycle? Have they really had that pressure to understand how they think when it's not going as they want it to? Not just in a week or a quarter or even 6 months, but a proper cycle there. So we would very much want to focus on the long term, and on those managers where generally there's probably a little bit of grey hair, to be honest with you. They bear the battle scars of markets, and that's for us is a key characteristic.
I was going to say, given how markets have been for the last sort of 10 to 15 years, it's it's been a sort of unusual cycle, and therefore I was thinking, when you're talking about experience, obviously a lot, the industry likes to talk about 3 years. We all know that's short. Not to say that managers can't obviously continue to do to generate a fantastic track record, but to fill the box that you were talking about, I was thinking in my head that sounds like quite a lot of years of experience. Have you got? I mean, I suspect you don't have a specific figure, but is there a sort of a figure that you'd like to that makes you feel more comfortable if you know that the manager has more than X number of years experience?
Yeah, we don't have a hard rule on this, but I think minimum 5 years. If they've got 10 years, then, and often I think about the managers we use, they're not often they do have that 10-year experience. We're always going to look at those managers that don't have that length of track record, and particularly you want to use it to spot up and coming managers who you think have got something there. But I think these market events can persist for quite some time, and if we go back to the last decade, really, you could have been a fixed interest analyst or a fixed interest manager and run your fund for nearly 10 years and never seen a US rate rise. So you can have quite a lot of experience, but I've only ever seen one side of the market. So it is important that you dig deeper in that, and I think that's been particularly relevant for fixed interest over the last few years. There was no manager alive that could say, well, last time we had QE or anything like that, this is how we invested. It was all new. So you also have to be cognizant that sometimes that looking for that long-term experience isn't always the answer, because new things happen. I think that is rare and unusual, and we need to look past that for most of the time. But the experience, I think, very often, we all know the sayings about history doesn't repeat itself, it rhymes, etc. I find myself talking to the younger guys in the team when they start talking about something, and I'll say, "Oh, I remember in 2004 there was this manager that they did this, and it was a similar environment, whatever it was." I find myself crawling to the back of the memory to dig out those examples, and they look at me like you're just the old timer reminiscing about the past. But it's important that they are your lived experiences.
Oh, 100%. Yeah, that I think that's one of my favorite phrases, to be honest. I've just seen that time and time again. So you've got a big team now, right? You said at the beginning, obviously, or you said earlier that you started and there was nothing, and now there is a big team, and you said obviously the process and way of doing things have evolved. Can you give us a sense of the sorts of things that have evolved over that period?
Yeah, definitely. I mean, there's the kind of basic sort of things in terms of the systems and how we're analysing managers and the processes that we're using around that. But I think to give you one really tangible example, which is very relevant over the last few years, would be something like how we monitor liquidity. If I go back to 2016 when we started there, I don't think too many people were really that worried about liquidity. It wasn't a conversation that I would have had very often with managers. They certainly weren't bringing it up. We might have occasionally talked about it when we're looking at small caps and things like that. And now liquidity is one of the forefronts of the things that we look at, even before we've met the manager, to understand the liquidity profile. So that has involved us going through building our own liquidity framework, building our own tool to think about how we analyze every single fund that we use, fund and open-ended and closed-ended that we use, and then how we use that to an early warning trigger to prompt more work, which then might lead to more conversations with the manager, which then might lead to more conversations not with the manager but with their risk team and their compliance team and their traders. And so on. So that is definitely an area for us where started off thinking, okay, we don't need to worry about this too much. Running a tiny amount of money when you're starting, you're using largely large ETFs, so it doesn't matter there. And then as you grow the business, you start investing in these other assets. Your assets grow themselves, and you start thinking, well, actually, we own 3% of this fund or 5% of this fund. What happens when we want to exit? Can we exit? A fund might be £1 billion small cap fund. How does that impact the manager in terms of the decisions that they're making? So that is one area where I think we've really evolved significantly over time and upped our game. And I look at the tools that we've built to analyze that and the level of monitoring that we're doing. Then I think that's something that we could say and look at and stand behind and say that is a very good piece of work that acts as an excellent early warning system for us for some of our exposures.
Have you used that in advance and not invested as a result of the data that you've discovered on that?
Yeah, definitely. I mean, also, I think just probably to expand on that a little bit more, you really need to think about where the liquidity you see on the screen is not the liquidity that is in the market. And I think that's often forgotten, particularly sometimes when you're looking at some of the very broad measures there, and particularly when looking at small cap. You need to think about the other execution venues that exist in the market. So then you need that broader market awareness to understand. But yeah, absolutely, we will use that as a trigger when we're looking at funds, whether it's pre-investment and then rule it out, or post-investment. Maybe we need to exit because we're worried about liquidity there, and or just we need to be conscious of it and monitor on an ongoing basis.
Yeah, makes a lot of sense. And you mentioned meeting people obviously outside of the usual suspects that you might have met, back in 2016. So can you give us a sense of what your team is looking at prior to investing in a fund? How deep are you going? Obviously, you've got the manager, but beneath that, what are the other pockets of teams? Is it just the risk teams only when there is something like this that you need to dig into, or what bits are kind of standard as part of that process?
Yeah, I mean, we don't tend to go look at things like risk teams and so on prior to investment. We try, and I think the whole process has been geared around this. Comes back to this blank sheet of paper approach. Is we try and focus our time on where it adds value. I've worked in larger teams before, and I sometimes got a sense that we were doing research for the sake of doing research. If your job is research, it's a kind of undefined task really, and it never ends. And what I've found is there are lots and lots of people doing, just ticking every box really, and I wouldn't say focusing in on where the issue was. So what we've tried to do in our whole process is spend our time where it adds value, and using it as a kind of identification of potential up and coming managers, or as an early warning where we see risks or potential risks in our process. If a manager is doing as we expect them to do, then we're quite content and relaxed to leave them well alone and not take up their valuable time in asking them basic questions. But to get back to your broad point about what do we do up front, really what we're trying to do is identify stylistic characteristics of managers early on in our research process, so we understand how we think they should perform. I would generally contend that most managers you can put into a style box. I think there are very few genuinely rotational managers that are able to invest consistently across whether it's a value market or a growth market, and rotate well across that and have such consistent returns. So trying to identify those style characteristics early on, using our quantitative analysis to draw that out, and then where we see managers we want to go deeper on, then getting in front of them. I think there is no substitute for that human interaction and getting to know managers as people. It's telling the answers that you get from them. It's amazing. But we would always have two people from our team going to meet a manager. It's amazing how two people can be sat in the same meeting and walk out with a different conclusion or observation about how things are answered, or body language, or all those types of things. So we really want to understand the manager and the style, get in a room with them, and be very clear how they articulate their own investment philosophy and process. And that might take 2 or 3 meetings to get really comfortable with that. And it might fall by the wayside in that approach, but we want that deep understanding of the philosophy and process, because that gives us such a strong frame of reference. If we get that right up front, it saves so much pain when you have invested, if you've made that decision. Because if a fund is underperforming, and it should be, because you've understood what they do, actually you don't need to waste too much time investigating all of that underperformance. So you can spend it again on the areas where it really, really matters there. So it's the deep understanding that's key for us.
The body language point is a really interesting one, and it's something that obviously there are whole, you can do whole kind of lifetimes of work in that area. How much is the kind of the way that you interview and the kind of those looking out for those body language signals something that you give much attention to?
So if you'd asked me before COVID, I'd have said it's really, really important part of what we do, because you're always doing face-to-face manager meetings. And now we do so many meetings like this, where obviously it's much harder, and it's probably downplayed the relevance of it a little bit. I think as much as the kind of body language reading of people side of things is actually what you're looking for is consistency of behaviors and consistency of the answer of the questions, and a kind of confidence and clarity that comes from that, and particularly in terms of how they answer the process, and also thinking about how that is answered across the team as well. I always find it really interesting when you've got maybe a manager and a co-manager, or a manager and a deputy in the meeting. I think that's where you can read the relationship between people in terms of how they answer the questions. Isn't it sometimes telling when you've got maybe someone senior and junior in the room, if you deliberately ask your question to the more junior person, does the more senior person step in immediately and not give them a chance, or does the junior person look to the senior person for kind of confirmation and a validation of the points they're making? And those kind of things can be quite interesting in thinking about how's the decision-making dynamic going on within a team. So I kind of use body language as a throwaway. I think it's so much bigger than that. It's how people behave with each other.
Yeah, that's really interesting. So you touched on the kind of the team dynamics and the kind of, I suppose, the decision-making process or way of working. How much do you as a team consider the broader kind of cultural aspects from the firms in which they operate?
Yeah, we do and always have. And yeah, you need to be happy at work to deliver your best. So that organizational environment is how we've always framed it, and I kind of framed it like that going back long before people started talking about culture at work and all those types of things. The organizational environment you work in needs to be a strong, supportive, cohesive environment to get the best out of people, in my view, and therefore we want to make sure that people are operating in that way. And I can think back to one example many years earlier in my career where we really liked a manager. He was really candid with us in the meeting that frankly didn't think he was paid enough, and he was not paid as well as his peers in the industry. Now, obviously, if they're as candid as that, you really do need to start asking some questions about the organization. And actually, we said, we really like what you do. We love your fund. We like your process. You're coming across a very good fund manager, but we can't invest because we think you might well leave this business. And actually, we ended up having a discussion with the organization and identifying the risk. And ultimately, they were given a pay rise and they stayed. And needless to say, we had quite a good relationship after that with them as an investor, because we really got into the depths and we wanted them to thrive in that environment. And they did. So the whole culture, organizational environment is very important. We've probably all worked in places at various times have thought, oh, this is it's a bit of a tough one coming to work at the moment. It's not the happiest place, or it's not the greatest place. I mean, every organization goes through those times, and it does make a difference. So we want it to be happy and supportive. It's why we have where we see organizational change in a business, that's one of our red flags for thinking about, should we change a manager? Are they going through M&A? Are they up for sale? There again, we know the turmoil that can create in a business, and so it might be nothing wrong with the fund, nothing wrong with the manager. It's performing well, and we might still put it on our watch list because there's a wider cultural organizational issue going on that we think maybe this might be to the detriment of long-term returns.
Super interesting. I definitely have that's the first time I've ever heard of a fund buying team facilitating a pay rise for a fund manager. Maybe that should be the new approach for fund managers to get paid.
Yeah, well, if any are listening, then I can't promise that's always going to be a successful outcome, but I'm always happy to go into bat for good managers if they need a little helping hand at pay review time.
There we go. There's the offer. Take that. But in more serious note, the cultural thing is so interesting, and obviously culture is a sort of term that's banded around, but to your point, it's always existed. So definitely interested, to dig a little bit into that example you gave at the end, where fund manager might be great, performance might even be great, but actually you've got a concern. Can you just give us, a few examples of things which might, make you consider something like that, where actually on the face of it everything's good, and the asset manager would probably be quite surprised for that to occur?
Yeah, I think it nearly always will come back to that organizational change point. And if we think about the last few years in asset management in terms of businesses that are struggling or on outflows, as a whole business, again, not just a specific fund, but as a whole business, and the threat of M&A activity, takeovers, and so on. That is really, I think, where the main focus comes from there. I mean, I'd love to give you examples of where you could kind of get inside the business and give you some deeper examples, but it's so hard to get that. You're an outsider looking in rather than insider looking out. So it's very, very difficult to get that. That said, I do like to try and get a good relationship with the manager so that they're in a position where when we meet, we can talk not just about, okay, what stocks have you bought and what have you sold and why you did it, but try and judge that happiness factor effectively. And it's difficult, that, because it is totally subjective. All of those decisions, go back to that art versus science. The quant work doesn't tell you any of that. It'll tell you if assets are coming in and out, of course, but it won't tell you what's happening within an organization. So using the wider network, chatting to peers, what are they finding out? People you've known a long time in the industry, just getting that extra sense of what's happening there. It's hard. It's a soft skill. I couldn't point to one brilliant example to say, we did that because we saw this. It's just another cumulative weight of something. I mean, that's probably a little bit unfair. There's probably one example. I'm not going to name the firm, but there was one example over the last couple of years where we said we're not going to go and see any new managers from that firm because the threat of organizational change was too great in our minds, and therefore we were happy with what we held, but we weren't going to review any new managers because we just thought we can't guarantee those managers are going to be there in 2 years' time.
Yeah, and to your point, it's been a tumultuous time for the industry. So yeah, definitely going to continue to see that for a while, I suspect. Okay, interesting. So I wanted to just spend a couple of moments talking about, you've got obviously your bias to it's passive unless we really believe it's going to outperform, which is absolutely the way to do it. If you do go active, is it typically in certain sectors? You referenced small caps a couple of times, but are there sections of the market, like I believe that you can outperform in any market if you have a genuine edge, but do you agree with that, or is your view actually US equities actually you can never outperform, or whatever? Like, are there certain areas that you don't look to go active effectively?
Yeah, there's one area there where I would say we would never go active, would be UK gilts. There, I think the ability to outperform and the magnitude of the outperformance potential is so small that save your 25 or 30 basis points active fee and go passive, and passive's got so much cheaper. I think that's probably the broader point for me, is the bar for using active just gets higher because the cost of passive implementation gets lower. And it's almost like the cost of passive has fallen faster than the cost of active, and we have this conversation regularly with asset managers. Say we like what you do, we'd love to use you, but yeah, you've given yourself an 80 pip headwind before you've even started every single year there, and we're not sure you can deliver that. And I don't think the active management industry has quite worked out that this pressure is so great, and that they're really at risk of losing their businesses unless they wake up to it. But I mean, I come back to your point. I like to start and say that there is the ability to outperform in most markets, but actually we come at it slightly differently. We really do want to blend our manager styles within subsectors. For example, if I took something like EM and Asia, there it's not about picking one manager and outperforming. It's about picking the variety of styles and how you blend them together, and ultimately you might deliver a better risk adjusted return there. But to be honest, so often now the mandates that we might be getting from specific advisors to run bespoke money for them, they come with fee budgets, and therefore you're kind of being forced down a route to use passive in a lot of areas. US equities, we do use active managers in US equities in a lot of our mandates. Often that's paired with some low cost S&P 500 beta, but we're happy to use active managers. But we might be thinking about blending a higher growth manager with a value manager, and again trying to just squeeze out that risk adjusted return a little bit better. But yeah, there are a few areas where we'd say absolutely not, particularly when the opportunity set is wide and the inefficiency should exist in the market, but it doesn't always work out like that.
Yeah, completely makes sense. Can I ask, just in terms of your comments around active and passive, and obviously it's been just insane, right? That journey, as you alluded to earlier. Active ETFs are getting a lot of traction, and they do have a much lower cost to implement. Is that something that you are making use of at AJ Bell?
we have, thinking across all of our portfolios, we have made use. I mean, I think of them as, I think the ETF moniker against it is, it almost is a little bit misleading because it's taking up all the attention. To me, it's a systematic strategy that's wrapped in just a different structure to an open-ended fund. So let's separate the two, the active and ETF. Let's park the ETF. There's an active element of a strategy that's being run that's going to be systematic, and then you can choose how you want to implement it via an open-ended structure or an ETF structure. I suspect we'll see more and more going down that route in the ETF structure. There's relatively few choices at the moment in the UK, but that will invariably change. And we've been big users of ETFs all the way through since we started. Our preferred passive vehicle was the ETF structure. So if more moves that way, we are entirely comfortable making full use of it. And as you rightly say, fees are typically coming in a little bit lower. And that's going to put the squeeze more on those active managers who are more traditional and are perhaps a little bit more reluctant to change. I mean, I would say on that point as well, just to finish that off, I talk to so many management teams of asset managers, and this reluctance to think long term about the future of their business is really quite surprising and frustrating. It's almost like they're parking these bigger picture decisions for the next CEO. Or the next board. There might be 3, 5, 10 years down the line where they've got a real business threat, but I think they're probably almost thinking they're not going to be there in 3 years' time, so let's not worry about it. It's someone else's problem. And there you can see how the active asset management bit of our industry ends up sleepwalking into a real problem that is then too late to get out of.
Yeah, it sounds a lot like politicians in that respect.
Yeah.
What would you say? It's obviously a huge topic, and we're towards the end of the podcast. But what would you say? Your view is on how what they can do today that means that they are safer in those 3, 5, 10 years down the line.
Yeah, I think two things is one is concentrate on what you're genuinely good at. So many active managers, asset managers have tried to be all things to all people for too long, and I'm on record historically as saying 80% of active funds should be closed, and I stand by that. And I tell every single asset management firm I talk to, get rid of stuff that you're subscale, that you're not world class at. Focus. If you're world class at something, you can charge a premium price. There's nothing wrong with that if you're genuinely world class. But if you're trying to have just to have shop front coverage, you're not going to differentiate yourselves from it. So focus on being world class and understand fees and where they're going in our industry. Getting 70 bips of a large investment, well, sounds great, doesn't it? But 100 bips of nothing is nothing there. And they really need to understand the direction of travel of fee pressures, of what advisors are asking for, what clients are asking for. And I'm happy to say I think active managers they've over-earned for too long in delivering some pretty mediocre results for investors, and they need to understand if they carry on down that approach, they're not going to have a business.
Wise words from you today. Yeah, no, I think it's an absolutely crucial time for asset managers to focus in, and to your point, it's been too long with strategies that are not fit to deliver for the long term, and will never be bought by the likes of you and many others out there. So yeah, all right, well listen, that is fascinating. Did you want to say something?
I was just going to say, actually, on the one area where it is good and we are seeing positive is, and this is the area you're very familiar with, is investment trusts. Obviously the independent board nature there, the constant chipping away at fees over time, it's a really good example of how it can work when you've got genuinely independent management board structures, and so that is going in the right direction. So obviously the FCA is trying to get there a little bit with the open-ended side, with fair value assessments and independent board, independent members feeding into that process, but it's not working just yet. But investment trust, tick in the box, definitely doing the right thing.
Gonna give a double thumbs up to that. Cool. So gonna finish with a few questions. just to kind of dig into you a little bit more. And the first one is something that I always used to like to ask managers themselves, which is thinking about a book. And a book that has, I'm sure like many people that I speak to and that I've interviewed for this podcast, you're probably a big reader. But is there one book that you could pick that has had the biggest impact on the way that you think about things?
Yeah, there probably is. I would say The Hour Between Dog and Wolf by John Coates.
Oh, I've never heard of it. The Hour
Okay.
Between Dog and Wolf. Okay, let's hear about
And
it.
actually,
Have you got it? Let's
reason interested is because it's right there on my desk.
Dog and Wolf. Okay, tell
Yeah.
us.
Now, John Coates is a former investor turned researcher, and he's done a lot of work on behavioral finance. But where he's taken it the one step further is actually thinking about how the physiological impact of someone, how it impacts their decision making. So, for example, making a decision, if you get a decision right, an investor, you'll actually have a testosterone release there, and that basically the more testosterone you release, the better you feel, the more confident you get, and the more risk you end up taking there. And then when you get it wrong, you have the testosterone crash and so on. So he's taken the behavioral finance aspect that we would generally think about, well, that's just about how you make decisions, into, okay, but how do you make decisions? Is that a chemical reaction in your body that's doing that, or is it just the conscious? And he would argue that actually the conscious is being informed by how your body is made there. So that book came out in 2012. Actually, I saw him at a conference talking about it, and I was absolutely fascinated to actually think about this in terms of how does that change or evolve my thinking about simple behavior finance when I'm talking to fund managers, and particularly around risk taking. Now, you and I would have met managers that have got well and truly carried away with a stock over the years, and maybe they've made 100%, 200%, and you're saying, is it not time just to bank a little bit of profit? No, it's going to double again and double again from here. And you can start seeing how that behavioral deeper aspects exacerbates their risk taking. And the next time you go and see that manager, that stock's down 90% because it's had profits warning, whatever it is. You say, we did talk about this, didn't we? And I can think of real managers I've had that exact conversation with, where they just got carried away, and we would think about, oh, it's just falling in love with a stock. Well, I think what John Coates shows in his book is it's deeper than that. It's much deeper than that, and he takes it to extreme levels by saying that traders should actually have their hormone levels measured every day, and that you'll see it going up and up and up, and that managers, when they see it going too high, should actually take capital away from them and take them off the floor because they're at risk of taking making some bad decisions. So I think it's interesting, it's thought-provoking, and it takes behavioral finance, which I find fascinating, to a whole new level. I can't do too much with it because I'm not there taking the blood of the fund managers when we're meeting them, but
You've got them on your team.
yeah, that's it. But I do think it takes behavioral finance to a level that is most people don't think about.
Wow, I'm gonna have to check that out. That is certainly a topic I've not heard talked about before, at least in that context. I've always found, or I've increasingly found it fascinating how sort of as humans we believe that we are sort of totally in control of everything that we do, and then actually sometimes you see the sort of Derren Brown examples where they send people through kind of London in a taxi, and they get them to draw something, and they all basically draw the identical thing because Derren Brown's team have planted all these things on the way there, and we're all just completely influenced by what we've seen, but we think it's our own idea to draw a zoo or whatever that they saw on the way there. So no, that is really, really fascinating, and sounds like something people should probably pay quite a lot of attention to in that kind of realization that there's more there than we might like to think.
Yeah, absolutely.
Awesome. So next question comes from our previous guest. So last time we had Carly Morehouse from Quilter Cheviot, and she wanted to know from you, what advice would you give to your younger self? What investment advice would you give to your younger self?
Oh, so many things. You give yourself such a talking to, wouldn't you, now?
I actually made a joke with her that when she asked the question, I was like, I'm going to have to ask that earlier on in the podcast because there's going to be so many things. But
Yeah.
if you've got a few moments
Yeah.
to succinctly say what the many nuggets of things that you now know.
I would say don't be frightened of learning from your more experienced colleagues. Yeah, they've got, it's come back to what we talked about earlier. They've got the battle scars. They've been through similar experiences before. Yeah, when you're young, you think you know everything. You're quite blasé about that, and your colleagues, your older, more experienced colleagues, have got so much knowledge to give you, and if you take an active curiosity in them and talking to them about it, it is amazing how much you can learn and will learn. I didn't do enough of it when I was a young starting out investor because I thought I knew the answers, and now I reflect on it and think, yeah, I worked with some really good people and they actually were very wise, and I could have taken more from them.
Awesome. Yeah, that's a, I would say, an underappreciated fact, probably in general, actually. But yeah, super helpful. All right, so now it's your turn to ask a question for the next guest on the podcast. Is there a question that you would like to pose to our next guest?
I would be very interested, and obviously I don't know who the next person is going to be, so it's a total shot in the dark, this. But I would say, what event or events that have happened early in your career shaped who you are as an investor today?
Love that. What event or events early on in your career shaped the investor that you are today? Beautiful. That's going to be fascinating. Ryan, thank you so much. We have covered an enormous amount of ground, from your early career to the way that you think about things, to quite a bit actually about your business and the structure of that, and then talking about asset management and how we can perhaps see better longevity and stability of some of these firms, and then the questions at the end. So we've really put the world to rights, and thank you so much for your time, and have a great rest of your day.
Yeah, thanks for having me on. Really appreciate it. Love the chat.
My pleasure. Thanks, Ryan.